everybody's going to be at a different stage in their property journey. So I really hope that today we'll be able to give something for everybody, and there'll be something that you can take away, given that you've made this great effort to come in. I think we'll start with some introductions because it's important to know who your speakers are today. So I'll start by introducing myself. So my name is Tayo Oguntonade, and I'm the co-founder of Bricks with Tips, which I run with my wife. We started it in 2019, but we've been in property since about 2014, 2015. I've got a background in banking, and I've worked at a lot of the big investment banks, and we have a platform that educates roughly around 50,000 people on property. I'm also trusted by major broadcasters such as BBC, ITV, Channel 4, BBC News. So anytime there's any new property news, quite often I'm called by them to give my views and advice and tips on how to navigate the property space at the moment. And finally, I'm the co-presenter of the Bafta award-winning television show, The Great House Giveaway. Anybody watch The Great House Giveaway? Tough crowd. It's one of Bafta. The reason why you haven't heard of it is because it's a daytime show, and you guys are busy at work, right? Yeah? Good stuff. Let me give it over to David so he can let you know about who he is.
Yeah, good morning, everybody. So my name's David Gittin. I'm the sales manager for London Mortgage Partners. We're based in East London. We specialise in mortgages for first-time buyers, home movers, self-employed, but a little bit of background on me specifically. So the company itself was founded in 2019. I've now got 6 years in the industry. My efforts are now focused on bringing through trainee and new advisors and bringing them up to scratch on everything mortgage broker related. So yeah, experienced first-time buyers, home movers, buy-to-let investments, professional mortgages, so any doctors, consultants, etc. in the room, remortgages as well. A very vast experience of dealing with NHS, which is obviously a plus to being here today. So I've previously worked with Medway Foundation Trust, KMPT, King's College, Mayton and Tunbridge, which are a little bit more to the east. So I've travelled out a little bit today to come from the southwest. So yeah, what that means though is I've got a really good understanding of NHS income. So I've dealt with hospital CEOs, consultants, surgeons, nurses, radiographers, people in HR. So yeah, a good understanding. Hopefully going to be able to give you a few tips and hints as to how you can boost what you can borrow and get yourselves onto the ladder. Yeah, so over 700 mortgage applications dealt with in my time, which may sound like quite a small number, but actually, as a mortgage broker, you deal with probably 4 or 5 inquiries for every one mortgage that actually goes through, because you have conversations with people. You know, it's not for everybody there and then, but relatively experienced at this point in my career. And as mentioned as well, a specialty in freelancers and self-employed as well. So for anybody who works, bank, agency, etc., I've got a very good understanding of that as well.
Thank you very much, David. So I want to start today talking about what we're going to be talking about in today's talk. I think it's very, very important, just because, as I mentioned, a lot of you will be at different stages, and it's good to get an idea of what you'll be looking forward to and what will really benefit you. Mine and David's aim today is to kind of bridge that gap in information. So hopefully the majority or everyone here walks away with something that says, do you know what, I didn't know that, and that's going to allow my goal to be closer than it was previously. So that's our goal recently, really, and I think it is very, very possible. So I'll start off by talking about the issue, or we'll start off talking about the issue, which is the current property market and what it takes to buy property. We'll talk about the fixes, increasing the mortgage affordability, right? So house prices are outpacing wages massively, right? So we need to look at increasing that affordability so it can keep up with house prices. And then finally, the next steps, looking for a property. And I've been in property for quite a while, and I'd say that I have benefited quite a lot by picking specific areas or specific attributes of a property that help or boost that capital appreciation. And I'll be going through some of them today. Cool, so next slide. I always start with why property. Any talk that I do, I think it's really, really good. What it will do is it may reignite your passion for property, or if you've got no interest in property, it might make you think that, yeah, do you know what? I think I do want to buy a property. So why property, right? I always start with history, right? Property is embedded in British culture and history, right? It's almost like it's a pre-installed goal. Once you get into employment, a lot of people's aim is that, right, I want to buy a property, I want to buy a property, I want to buy a property. It's a tangible asset as well, so even if the values of the property do change, one thing it will always give you is a roof over your head. It's a store of value. We've been speaking about inflation, right? Inflation is going crazy right now, and property is somewhere where you can put your money away, and it stores that value. In fact, there's something funny that I always say. I'm sure that a lot of people in this room may have come across someone who they've got a child and they're working maybe in a similar job to you, something with a modest salary, but all of a sudden they've got 100k deposit for their child. And when I was a lot younger, I used to be thinking, how is that possible, right? You work the same job as me. And that's because property allows people to be accidental investors, right? What happens is 20 years ago, they might have bought a property for 100k, right? 20 years later, Muggins over here comes and buys it for 450k, right? By the time that I buy it, their mortgage might be worth about 30k, and they've got 400 plus equity in that property, which they can now use to allow their kids to have a deposit. So there are a lot of benefits in that you're just paying off your mortgage every single month, but you are building equity. It's like it's an accidental investment. And then security. Obviously now it's quite difficult with the cost of living. A lot of people don't feel secure in their rented accommodation. So sometimes owning your own home and making those decisions in your home can give you an element of security. And finally, capital appreciation, which I've touched on to some extent. So let's look at the current property market and what the issue is. Generally, average lenders will look at borrowing people 4.5 times their income, right? Once upon a time, this was a decent amount. House prices have gone so far that it really, really scratches the surface. If you've got a salary of £30,000, not all lenders, but on average, you'll find that lenders will lend you 135k, 40k, 185k, salary 50k, 225k, salary 60k, 270k, right? And we're in Wimbledon right now. These numbers aren't really doing anything in Wimbledon, right? And we're not even talking about deposit just yet. So house prices are going up quite significantly. Wages can't meet up with it. And what we'll be talking about is how to meet that or bridge the gap. Are we heading towards a crash, right? That is a question that a lot of people ask. I'll say that house prices are getting to a point where they may stall or slow down, or they may reduce a little bit. But there's a big difference between this financial period and the last one. There's a lot of regulation in place that protects the market, so there's not any irresponsible lending. Whereas back in 2005, you could do something like a self-certified mortgage, which is where you walk into a bank and tell the bank that you earn 150k and they won't check any documents and they'll lend on that. That isn't possible anymore. I wanted to touch on the effects of the global pandemic. We had the global pandemic affected every single industry, right? And the property market was saved. The reason why I say that is that the government brought in stamp duty holiday, mortgage payment holiday, relaunched 5% deposits, and the furlough scheme indirectly helped people. It made people able to be able to pay their mortgages. So it did survive during that period. And what that's done is that that's built up so much demand that is forcing house prices up right now, because everybody still has the means to buy property. I always talk about timing the market versus time in the market, right? A lot of people are looking for the perfect time to buy a property. And naturally, I would have thought as well, a global pandemic that affects every single industry would cause house prices to go down. However, we saw the numbers and it did exactly the opposite. And that's why a lot of people say you're rewarded for your time in the market rather than trying to time the market, because property is a long-term investment, right? Even if we look at the financial crisis, 2007, 2008, it took about 7 years for house prices to return to the same level that they were at. So, for most people, when you buy a property, you're looking to be in there for 10 years plus anyway. Now, the London Borough of Merton, which we're in, has average house prices at around 568k. In 2020, they were 500k, so that's a 68k increase in just 2 years. And in the year 2000, they were roughly around 150k. So we can see that house prices are really, really just getting out of control at the moment. So this is where we start. That sounds very gloomy, right? Let's start working on the fixes, right? So what does it take to buy property? Now, right now, you can put down a deposit as small as 5%. Sometimes it's backed by a government, by a mortgage guarantee, but sometimes lenders will just offer it because they're comfortable giving the 5% deposit. In most cases, some of you may know, I might be teaching some of you how to suck eggs right now, but we'll get to some more intricate stuff later. So in most cases, smaller deposits will lead to you paying a higher interest rate. And the interest rate is what you pay on the mortgage, and it just means that your monthly payments may be a bit higher. The higher your deposit, the more lenders you'll have access to. So if you put down a 5% deposit, it is a little bit risky because you're taking out a 95% loan. So only some lenders will lend on it. However, if you have like a 25% deposit, the risk reduces and more lenders are open to it. And when there's more lenders open to it, competition increases, which basically drives down the interest rate and the price that you pay for your monthly mortgage effectively. So a question I get asked a lot, let's throw that in there. Should I put down a 5% or a 10% deposit? There's no real right answer to it because it depends on the situation you're in. I mean, if you live in London Borough of Merton and a 5% deposit represents, let's just say a 500k property, so a 25k deposit, going from 25k to 50k, which is a 10% deposit, it could take someone 8 years, right? So you've got to ask yourself, is my savings going to be outpaced by the property market? And in a situation where it may take you 8 to 10 years to save another 25k, it might. So it might actually be worth you getting a 5% deposit. One tip I always tell people that if you're going to put down a low deposit, the way you can hedge against it is making overpayments. So with most lenders, if you make overpayments, let's say your mortgage payment is £800 a month, a lot of lenders will let you pay £1,000 on a certain month if you're having a good month. And this is good because even though you've got a higher interest rate, ultimately when you pay that extra £200, that comes off the capital alone basically. So it can really, really reduce your capital and your debt. So that's a nice tip. You could go for 5% and make overpayments. But in any case, you want to be speaking to a qualified mortgage broker. And it's good that we've got one in the building, right? Boosting your existing deposit. So a lot of you may have heard about a lifetime ISA. And this is a government scheme now. With any government scheme, right, the first thing that a lot of people ask is, what's the catch, right? I would say with the lifetime ISA, there's no real catch. So long as you understand it fully, it can benefit you. With the lifetime ISA, how it works is that the government will give you a 25% bonus on anything you save up to £4,000 per year. So if you save £4,000, they'll give you an extra 1k at the end of the year. Now, the catch, but it's not catch, about the lifetime ISA is that you can only take out that money to buy a property, basically. So if you're considering a lifetime ISA, one of the things I always say is that you need to be committed to buying a property. Now, I kind of like that because what it does, it makes you accountable, right? No one wants to lose money. The thing that we hate more than spending money is losing money, right? So if you try and take money to buy something else, a car, pay for a wedding, they're going to penalise you. So if you are considering a lifetime ISA, make sure that you're committed to buying a property. Next is credit. Now, we all know that if your credit isn't up to scratch, you may find it difficult to buy property. So, why does credit matter? Credit is your financial CV, right? Your credit allows people to see what level you are at when it comes to making repayments. Are you reliable? Are you going to make your repayments on time? And this is what lenders have access to. There's 3 main credit referencing agencies that you can use to do your report. So, they're Experian, Equifax, and TransUnion. Now, you can actually access these reports for free, and it's really, really good to look at your report because sometimes you can take an action today, and it will take 3 months to reflect on your credit report. Sometimes it can take 6 months. So always try to look at your credit report as early as possible because if the action you take today could benefit you a lot further in the future, and we don't know what's going to happen in the future. You may be due for a pay rise that you don't know about today, but that pay rise can make you able to buy a property. But if your credit isn't ready at that point, it may negatively affect you. So we always want to try and look at our credit reports at least once a month and get it sorted out as early as possible. Now you can view your credit report for free. We all have something that's free, right? So you can go over to Money Saving Expert Credit Club. So that's on Martin Lewis's Money Saving Expert. Sign up to the credit club and you can access your Experian credit report for free. Credit Karma will give you Equifax and ClearScore will give you TransUnion. So those are the 3 credit referencing agencies covered. My top tips for improving your credit score. Quick one, register to vote. Even if you're not going to vote, if you register to vote, it lets lenders effectively see where you are, right? If someone owes you money, you'd like to know where they are, right? So when you register to vote, it lets lenders know where you are. Keep your credit usage low. So if you've got a credit card that's got, let's just say a 3k balance, try and keep it under 1,800. Lenders look closely at what percentage of your available credit you're using. If you're using a high percentage, they'll see it that you're dependent on the credit, and they will be cautious about lending you anymore. Record your rent. That's an interesting one. So I guess a way to build your credit is you could do loads of things. You could a good way to build your credit is by paying a loan on time or paying a credit card on time. And a lot of us pay rent, and that's a regular monthly payment. Now, there are some platforms that allow you to record this rent and, as a result, boost your credit rating. So, Credit Ladder and Canopy will allow you to record your rent, and this can in turn improve your credit score. Now, if you're in social housing, it is still possible. You can use a platform called Rental Exchange, and that can help to build your credit report as well. Get a credit builder card. Now, a lot of people's problem when it comes to credit is that they have no credit history whatsoever. And lenders want to see examples of where you paid credit on time and so on and so forth. So you need to have some level of credit to build a credit. If you have no credit history whatsoever, one thing you can do is get a credit builder card. Now, credit builder cards have really, really high interest rates. But the idea is that you pay it off in full. If you pay a credit card off in full, you won't have any interest to pay. So you can, the way that, and I did this as well, the way that you can do it is have certain purchases that you use your credit card for. Maybe it's fuel. And every single time you fill up the tank with a credit builder card, and when you get home, you pay off that card in full. Or it could be like shopping. Every single time you come home from Tesco, you pay that card in full. It's very, very important to pay that card in full. But if you're able to do this, you will see your credit report and your credit score improve dramatically. And then finally, there's Experian Boost, which can help to boost your credit score as well. Check that out online as there's information on that.
Following on, what does it take to buy a property then? So Tayo's already covered interest rates. Obviously, the interest rate is how much you're going to be paying back to the lender. Mortgage terms, and this is just some very high level, just to bring you up to scratch on mortgage terminology. Mortgage terms is the length in which you're actually paying your mortgage back. So is it 25 years, which is actually a little bit of a myth that most people seem to think that the longest a mortgage can be over is 25 years, but actually you can get a mortgage now 30, 35, 40 years. So you can stretch it out. Obviously these days we're borrowing a lot more money than we used to need to buy a property. So stretching it out over 35 or 40 years is going to reduce your committed payment rather than over 25 years, which 15 years ago was probably quite easy to do. But yeah, with the increased borrowing, stretching out keeps that payment nice and low. Repayment types. So some of you in the room may know the term interest only, which once upon a time was a very common repayment method. It is literally where you borrow money from the bank and you only pay interest back, so you never actually pay back the capital. Now, quite rare to get an interest-only mortgage these days, so what we opt for now is capital and repayment. So every month your payment is made up of capital that you owe to the bank and the interest that they're charging you as well. And then standard variable rates and early repayment charges. So the standard variable rate is a bank's standard rate, which they charge to everybody on an annual basis. Now, typically, a standard variable is much higher than certain deals that you could potentially get through a fixed rate, for example. So a fixed rate is simply where the lender fixes your interest for a set duration, maybe 2, 3, or 5 years. Personally, I am a massive fan of fixed rates because they tend to be quite a bit cheaper than the standard variable rate. And one thing that they give you as well that the standard variable doesn't is security, because you know exactly how much you're being charged, how long for, and it allows you to budget effectively. You may have all seen recently the Bank of England has put the base rate up again. So if you are on a standard variable rate, that means your interest rate is going up because the Bank of England have increased their rate. So a fixed rate can protect you against this. And yeah, any changes, you know exactly what you've got for that duration. Mortgage lending. So how much can you borrow? So Tayo's already covered it off. Most lenders are looking to lend somewhere around 4.5 times your gross annual income. Now, there are some lenders who will lend more, and I can give you some tips and tricks as to how to access that higher lending. When we get into one of the next slides, I'll cover it off in a bit more detail. 4.5 generally is where most people are going to land, subject to your commitments. Children, dependents do come into part of the affordability assessment. It's very expensive to raise children, so lenders do need to factor these costs in. But there are some lenders that will give you up to 5 times your income, potentially even 5.5 times your income. Now, when we give you these numbers, 4, 5, etc., it doesn't sound like much, but to get from 4.5 to 5, or even 5.5, that could be, for example, if you £40,000, it could be an extra £40,000 worth of mortgage, which could be the difference between a 3-bed and a 4-bed, or an apartment and a house. So impacts of debt. So credit cards, loans, car finances. Credit these days is actually so easy to access. Every time I open my Lloyds banking app, it's right there. Do you want a personal loan? £7,500. Now, credit is good. It gives us access to things like vehicles and technology, but you need to be careful when we're taking out credit. You don't want to be too over leveraged. Now, the good thing is that lenders are they're pragmatic in their approach. They're quite understanding that cars, for example, most people have car finance. Some of you may not, but a lot of people do. Credit cards as well, very easy to access. So most lenders have a tolerance built in for credit. So a general rule of thumb, I would say, is ideally try not to go above around 2,000 outstanding on a credit card. And if you have a loan or a finance of any form, try not to exceed around £300 per month. That is generally the sweet spot for most lenders. Now, if you do go above those limits, then that's when you're going to start seeing what you're able to borrow from them to decrease. So if you're looking at borrowing £300,000 and you've got a loan of, say, £450,000, that's probably going to have an impact and bring your borrowing down by approximately £50,000 or so. Now, it is very circumstantial, and it's not one size fits all for everybody. So if there are 2 incomes in a household, or even 3 incomes in a household, then that's going to give you a greater tolerance on outgoings and commitments. Likewise, people who have no children, over 2 or 3 children, there'll be more tolerance built in for those people. So very kind of generic figures just to give you an idea, but of course have a conversation with a broker and just go through your circumstances in full. They can give you some accurate lending figures. Myth busting. So bad credit. Now this is a conversation that I have on a daily basis. I've got bad credit. Can I still get a mortgage? Yes, you can. Is the answer. Now there is a mortgage for, I'll say it loosely, virtually everybody. So irrelevant of your credit circumstances, your personal circumstances, there is a mortgage lender for you. There's over 100 mortgage lenders in the UK. Now, when we speak about mortgages, people tend to just think of your big high street banks, your Halifax, NatWest, Santander, Barclays, etc. But there are lots of lenders and building societies that people haven't heard of that are able to take more of a manual approach. So a lot of the high street banks are driven by their systems. They've got money, they've got these fancy systems, and the system makes a decision as to whether they're going to give you a mortgage. Now, if you missed a payment on your British gas bill, or something happened with the parking ticket, you didn't realise about it, and now you've got a CCJ or something like that. Unfortunately, the high street banks, most of them, their system's going to see that and go, we're not going to lend to this person. Now, in my opinion, very unfair, because these things happen in life. So there are other lenders out there who we can approach and say, look, this is the situation, this is what's happened. And then they're going to review the information we give them, maybe ask you a few questions about the situation, and providing they're happy, they'll be able to give you a mortgage. So if you have bad credit, don't fear. There are mortgage options out there for you. Now, what do you pay for having bad credit potentially? Now, if it is the worse the credit, then obviously the more expensive the mortgage is going to be, because from a lender's perspective, they are taking a risk, because you present an element of risk of missing payments potentially. So they're going to offer you a slightly higher interest rate, or they might ask for a slightly larger deposit, maybe 15% rather than 10%, or maybe 10% rather than 5%. But absolutely, there are options out there. So if that is you, then have no fear. Documents required. So the standard stuff that we need is proof of ID, so your driving license or passport, proof of address, could be a driving license, council tax bill, bank statement, and then income documents. So 3 pay slips and 3 bank statements as well, just so that we can see the conduct of the bank account. So increasing mortgage affordability. Now this is the #1 question I'm asked on a daily basis. How can I borrow more? How can I buy that 5-bed rather than this 4-bed? What can I do to get the biggest mortgage possible? So there are, the first point on here is include all income. So we want to include as much income as possible. So if you have children, do you receive child benefit? Do you have tax credits? If you're a single parent, do you receive maintenance? All these things can be included towards a mortgage. It doesn't have to be your earned income. If you have any side hustles, I see side hustles seem to be the big thing at the moment, or even just a second job, maybe a part-time job, or for anyone who works bank, a big one. If your substantive post is with South West London, but they do bank for, I don't know, Kings, you can use that income. So yeah, as much income as we possibly can get can go towards your application. Now, what lenders are looking for is sustainability of the income. If you take on a second role and you've only done it for 2 months, then they're probably going to say it's a little bit premature. But if you've been doing that role 6 months, 12, 24, or even longer, then you've got a really good track record of having that additional income. And chances are we can use all of it towards how much you can borrow. The top one here, bonuses, commissions, etc., aren't really too NHS specific, but overtime is. And then more NHS specific income, so enhancements, night enhancement, weekend enhancement, Saturday enhancement, inner London allowance, shift allowance, any of these things, we can group all of that together, and there are lenders who will take 100% of it towards what you can borrow. So when we're looking at a payslip, it's not just the basic that you're receiving, we're averaging everything up, we're grouping it all together, and we're using all of that towards what you can borrow.
Anyone heard of a Habitat 1 mortgage? Oh, great, perfect. So it's going to be the first time hearing about it. So it's a mortgage product that fixes your payments for the entire term of the mortgage. So generally speaking, when you take out a mortgage, you may fix your mortgage for 2 years, 3 years, or 5 years. With them, if you take out a 30-year mortgage, that interest rate you take out on day one will be your interest rate for the whole 30 years. And the reason why they do that is that they focus on consistency of payments, and it also removes the requirement to remortgage. Does everyone know what remortgage is? Yep, perfect. Remortgage is a good thing generally, but this removes the requirement to remortgage. I guess this is the thing that sells it, right? You can borrow up to 7 times your income. So, who's eligible? First-time buyers, home movers, and pre-mortgages. So, hopefully that includes everybody in this building at the moment. You need a minimum deposit of 10%, or you need a minimum salary of 75k. However, they have mentioned that certain job roles only need a minimum salary of 25k, and it's in certain professions. And the reason that they've done that is that certain professions are in high demand, and they know that there's a level of consistency with the role. I'm sure you guys would agree that your job is in high demand, right? And you've got a level of consistency with what you do on a day-to-day. So medicine, dentistry, and vets are included. There's a list of job titles in here. I'll just name some: intensive care nurse, staff nurse, team leader in nursing, ward manager, ambulance paramedic. But I'll give Anthony the list so you guys can access that later. But there are all of these job titles are included, and what they'll do is that as long as you earn a minimum of £25,000, they will give you 7 times your income. But what does that look like, right? They've mentioned that when you talk about multiples, it doesn't sound like much. We'll look at the pros and cons, right? It allows you to borrow more. So if you have a 35k salary, you normally get a lender will borrow you roughly about 157,500. Whereas with 7 times your income, they will give you 245k. Now, just like David mentioned, this could be the difference between a flat and a house. difference between 2-bed and 3-bed. It can be a difference in the difference between distance as well. It can be moving 2 miles from where you are and moving 20 miles from where you are. So the income multiples make a really, really big difference. It's flexible, so there's no early repayment charges. So what that means is that if you want to change to a different lender, most lenders will charge you if you're in your fixed period, but with these mortgages in particular, they won't charge you any early repayment charges. So if there's a lender that has a good offering that you like the look of, you can actually just change to it. There are some cons with it though. You may not be able to find another lender that will fulfill 7 times your salary. So they've lent you 245k in this instance. When you want to move to another lender, you may find that the other lenders are only going to give you 157, which may mean that you're stuck with this lender. And in this case, this lender does charge a higher interest, which is one of the cons. They're fixing your product for 30 years, so they're taking on a big risk. And in order to take that risk, they hedge it by charging you a bit more on the interest rate. So that kind of sums it up. Now, once again, I always recommend speaking to a mortgage broker to assess all of your options, because you can't read this and think, yeah, this is for me. You kind of need to look through everything that you have, all of your income, the personal circumstances, and get an idea of that as well.
Nationwide recently launched something called the Help in Hand proposition, which, as we've been speaking about income multiples, so the golden income multiples, how can we get more than 4.5? So Nationwide will potentially lend up to 5.5 times. Now, there are some rules for it, of course, and they are specifically targeting certain people. So, as an example, a 55k salary would normally get you 247,500. Under the Nationwide Help in Hand, that's 302,000. So, quite a significant uplift. Now, it is restricted to first-time buyers only. Why is that? So, from Nationwide's perspective, first-time buyers, generally speaking, tend to be younger, maybe earlier in their careers. So, by lending them a large multiple today, what they're hoping is, in 5 years' time, you've progressed through your career, you've had pay rises, maybe you've had a yearly increment rise, you've gone on to a higher banding. So, the idea is that as you progress through, your salary is catching up and making it more affordable for you. So what do? They offer long-term fixed rates. So you can only get a 5 or a 10-year fixed rate with this product. And that is because they want to ensure that the volatility we're experiencing at the moment and the changes in interest rates aren't going to impact you. So as I mentioned, when the Bank of England changed their base rate and the standard variable rates are changing, that could fluctuate your payments. So they don't want their customers to be in a position where it fluctuates and it's up, and it's now unaffordable. So they get you on a long-term fix, 5 or 10 years. That way they know that you can budget over a long duration. They're going to do a really in-depth assessment of your disposable income to ensure that they're happy from day one you can afford it. And then their theory is, like I say, it should become more affordable as the years pass and salaries increase. Employed working status. So I would like to think everyone here is employed, but they won't take on any form of self-employed income. So if you do have a secondary role or a self-employed role, you cannot use the self-employed role towards the Help in Hand product. The reason for that is because, unfortunately, the self-employed, they get a little bit of stick when it comes to mortgages, because self-employed figures can fluctuate. The self-employed were quite heavily impacted during the pandemic, and unfortunately there are some rogue self-employed people out there who can manipulate their income figures. So because of that, Nationwide won't take the risk, and they'll only lend on your employed income only. But the good thing is, all forms of employed income, so everything I've previously mentioned about bank income, enhancements, overtime, all of that can be used towards boosting up to the 5.5 times. There are some minimums that they look for. So for a sole applicant, they're looking for £37,000 as a minimum, and that has to be basic, so that can't be inclusive of any overtime. But if you have a 37 or a higher basic, then you can include the overtime on top of it. And for joint applicants, they're looking for 55,000. So that could be partners, brother, sister, siblings, friends, be any relation whatsoever, but 2 incomes. As long as they total 55,000 or more, then you can access the product as well. And then lastly, the limitation on the properties themselves. So you can put down as little as 5% deposit on a house, but you have to put down a 15% deposit on a flat or an apartment. Now, the reason behind that is, speaking historically, houses tend to hold value a little bit better than flats and apartments, and they're seen as more desirable. So from the lender's perspective, because flats are more exposed to price fluctuations and volatility, they're hoping that with houses, that there's less risk involved of the property losing value. Joint borrower, sole proprietor. So joint borrower, sole proprietor is probably my favourite. I'll call it a scheme. It's not really a scheme as such. You know, it's not like Help to Buy or the government schemes, which Tayo will come on to shortly. But instead, it's more of a. It's to do with the ownership of the property. So let me explain. What is joint borrower, sole proprietor? So this is where you have more than one borrower, so i.e. joint borrower. So you can have between 2 to 4 people actually borrowing the money and on the mortgage. Sole proprietor means we have a sole owner of the property. So the most common situation we see here is maybe son and partner own the property and they're on the mortgage, but mum and dad come onto the mortgage as well, but they don't own the property. So we have 4 people liable for the mortgage, but only 2 people that actually own it. Now, the big advantage of this comes down to this. So the people who are purchasing and owning the properties, the property is taxed based on their property status. So if you're a first-time buyer, you have an allowance currently up to £300,000 on stamp duty. So if you buy a property for 300 or less, you pay no stamp duty. Now, if you was to buy a property traditionally, let's say me and my mum. My mum already owns a property. So if I was to buy with her, she would be buying a second property. So not only do I lose my first-time buyer stamp duty exemption, I now have to pay an enhanced rate of stamp duty because mum is buying a second property. So when you have 2 properties or more, the rate of stamp duty, it doesn't double, but near enough doubles. So it goes up quite a considerable amount. So under joint borrower sole proprietor, if I was to own the property, but me and mum were to both be on the mortgage, we can borrow against both of our incomes, but I'm only taxed as a first-time buyer. Now, there are, of course, some risks involved. Mum would have to sign a declaration to say that she has no control or ownership over the property. So there needs to be a level of trust there. Now, I say mum just because that's the most common setup, but you can do this with siblings. So we're seeing more and more common that brother is helping brother or sister's helping brother, or any family members. It could be uncles, it could even be friends, neighbours, strangers, if you can persuade a stranger to do such a thing. But yeah, so the owners of the property can be between 1 and 3 people, and we can have between 2 and 4 incomes on the mortgage. So you could have, like I say, 2 applicants and then 2 effectively guarantors, I suppose, to boost what you're able to borrow. So yeah, this is ever increasing. Year on year, the number of applications for joint borrower sole proprietor is really ramping up at the moment, because we are in a position where property is so expensive. We're looking at ways to boost what we can borrow. How can we buy that more expensive property, especially in London? You know, prices are ridiculous. Now, I don't want to get into the debate of can we fix the housing sector and make housing affordable for everyone, but at the moment we are sticking plasters on trying to achieve it right now. Some of the cons, it is based on the oldest applicant. So using the parents as the example, if you're buying with parents and let's say the oldest applicant is 55 years old, typically you can only run a mortgage up to 70, 75. So with a 15 or 20 year mortgage, your payments are going to be a lot higher than if you was able to run it over 35 or 40 years. So there's a bit of a balancing act that we need to do when we're playing around with the figures to get it to work for everybody. But the younger the second or the second borrowers are, the more advantageous it is.
Shared ownership. So has everybody heard of shared ownership, right? Shared ownership effectively reduces the barrier to purchase a property because you only buy a share. So you put down a deposit of a share of a property. So if I give you an example, if you buy a 400k property and you only purchase a 25% share, you're only buying 100k of that property. On top of that, in a lot of cases, you can put down a deposit as low as 5%, which means that you can get access to a 400k property at just £5,000 as a deposit. Now, you will go through affordability to A, ensure that you can afford the monthly payments that 95k mortgage will bring, because you've got a 5k deposit, you've got a 95k mortgage, but you don't own the remaining 300,000. So what about that 300,000? What you do is that you pay rent on that remaining 300,000 or that remaining 75% share. So what they are trying to do is reduce the barrier to entry so that you can buy with a low deposit, and then hopefully over time you can build up your equity. And they have a process called staircasing, whereby when you own that 25% share, you can actually buy another 25% share. So after that, you'll own 50%, which means that you'll be paying the mortgage on 50% of it and rent on the remaining 50% of it. And the idea is that you can staircase all the way up to owning 100% of that property. Now, let's look at the pros, right? The pros, as I mentioned, is that it lowers the barrier to entry because property deposits are one thing that deter a lot of people from buying a property, right? Again, we look at this area, property deposits, I mean, 50k, 60k, 70k, these aren't weird numbers, right? And it allows you to purchase only 25% share originally. But there are some cons with share ownership. What I've mentioned already, you end up paying a mortgage and rent, which can be quite costly on a monthly basis. And depending on the property that you buy as well, you could pay other costs like ground rent and leasehold charges and so on and so forth. One of the criticisms that share ownership actually does get is that you have all of the responsibilities of a buyer, but all of the restraints, should I say, of a renter. So, for example, you only own 25% share. If your toilet breaks, unfortunately, you don't get to fix 25% of your toilet, basically. Now, if you were a renter, you call your landlord and they sort it out for you. You only own a 25% share, but you have to foot the whole cost of that toilet, effectively. On the other side of it, you have to let the housing association know when you're making any adjustments to the property. Some are more restrictive than others, but some of them may say that, you know what, if you want to put wallpaper up, or if you want to restructure the house a little bit, you need to run it by us, and then we'll let you know if you're allowed to do that or not, effectively. One thing I always say about shared ownership is that make sure you do all of your research and be tactical around it as well. Government schemes get sometimes a bad reputation, but my main thing is that if you fully understand it, with a lot of these things, you can work out how it works for you. I give the example sometimes that one thing that I always encourage is that you should move further out, compromise your property, which I'll go into a bit later, so you can buy something without a government scheme, for example. However, I understand that a lot of people have a need to be in the city. Some of you may need to be in Wimbledon, you may need to give someone an element of care, you may need to be here for childcare, so on and so forth. So shared ownership could work well for you. And when you understand it, a lot of people are quite tactical about it as well. So some people might say that, you know what, I'm going to buy my 25% share, but I'm not going to staircase. I'm going to save all of my pennies after I buy that 25% share. And then at some point in the future, maybe 5 years on, that 25% share that was 100k, I'm going to sell it when it reaches about 140k. So I've got an extra 40k on top, and then I've got my savings of 10,000. Now I've got a 50k deposit, which I can use to buy elsewhere. One reason a lot of people might opt for that as well is because when you staircase, you may get to 75% share and you may realize that, you know what, I don't want to buy 100% of this anymore. And what it is that you have to sell that 75% share, right? And you may find it difficult to find a buyer that wants to buy a 75% share. A buyer with a 75% share, a buyer who can afford a 75% share of a 400k property can afford 300k. A lot of the time, they may not be swayed by share ownership, they may be just going to buy it by themselves. So it's all about really, really understanding the schemes as a whole. You go to the next one and we'll go back. Right to buy. Everyone heard of right to buy? Right to buy is a scheme that it's been in the news quite a lot because I think they wanted to make some adjustments to it. The adjustments that they want to make to it, they're not clear whatsoever. So we're going to be talking about the original right to buy scheme. So this is where council tenants can receive up to £116,200 discount from their council home list price. Now, to be eligible, you need to be a council tenant for at least 3 years. You need to have no property owned in the UK abroad or no outstanding debt or legal issues. Now, a huge benefit about it, which a lot of people don't know, is that if you are looking to buy, if your council house is listed at, let's just say, 350k, and the council's letting you know that, right, we're going to give you a 100k discount. This means that you only need a mortgage for 250k. Now, you may not have a deposit, but a lot of people don't know that a lot of lenders will allow you to use that discount as a deposit. So effectively, you can buy, if you've got a discount on your council home, a lot of the time you can buy a house with no deposit whatsoever because the lenders will use the discount as the deposit. So as long as you can afford the monthly payments of the mortgage, you can actually just use your discount as a deposit effectively and buy that property. So the final scheme I'm going to go through today is the government scheme Help to Buy. So what is the Help to Buy equity loan? It allows first-time buyers to put down a 20% deposit. So what happens is that you get a government loan of 20% or 40% in London, and then you'll get a mortgage on the rest. So we're in London, so this is how it would work. You put down a 5% deposit in the property. The government will give you a loan of 40%, and then you get 55% mortgage on the rest. How it works is that government loan, the 40%, they won't charge you interest on that for the first 5 years. But after the first 5 years, they will start to charge you interest on it. How can it help? It allows first-time buyers to put down a 5% deposit once again. And effectively, you do own the whole property. You just have to share a bit of equity when it comes to selling. So first-time buyers will also have access to much lower mortgage payments because in London, you're only going to be borrowing 55%. So remember, earlier on I mentioned that if you've got a smaller loan that represents a smaller percentage of the property, they're going to give you a much cheaper interest rate, and effectively your monthly payments will be a lot cheaper. However, it's important to note that you'll be paying your 55% mortgage, but after the 5 years, you will have to pay back that 40% loan. Now, how do you pay that back? In a good market, a lot of people pay it back by hoping that their property goes up in value. Now, when your property goes up in value, you can remortgage, and you may be able to get a lump sum out that can pay off that 40% loan, or eat into it quite a little bit. It's a complex process, but you'll speak about it with a mortgage broker, and they'll kind of tell you how to go about that. Now, it's important to note that the loan that the government gives you, the Help to Buy scheme, is an equity loan. So what that means is, let's just say that they give you 40%, which is an 80k, they loan you that 80k from the government. If your property goes up by, let's just say, if it goes up in value by 50k, you will pay a proportionate amount back to them effectively. So if it goes up by quite a bit, you'll pay them back some. But at the same time, if the property goes down in value, they will take less of the loan. So you may end up having an 80k loan from them, and when it's time to pay back the loan, you may owe them 100k. But that means that you made a profit as well. Similarly, if you make a loss on the property, you may only have to owe them 60k rather than the 80k that you originally borrowed from them. So your investments are aligned basically. If you lose money, you pay them back less. If you make money, you pay them back more. Things to consider. So first-time buyers will have to pay a mortgage, and then you're going to have to pay back the equity loan, which can be quite expensive. It can only be used on new builds. Sometimes new builds get a bad reputation, and that's because some home builders have built in a funny kind of way. There's pros and cons of new builds, right? So it's really, really important to kind of get an understanding of which home builders you'd like to go with and which you wouldn't like to go with. Things to consider as well, after the first 5 years, loan interest will be charged and it will increase every single year. But the main thing to consider is that the deadline, Help to Buy is coming to an end. So the deadline to register for Help to Buy is 31st of October 2022. So if you're looking to take on Help to Buy, you may have to act quite promptly. However, David's going to go through some alternatives to Help to Buy. So.
As I mentioned, Help to Buy is coming to an end this year. You have to register by October to say that you want to use it, and you have to be buying a home by March 23, because that is when the scheme will effectively end. Now, one of the cons is new builds only. So, making assumptions where you guys live right now, I'm presuming that there's not developers building properties where you are. There may be, but especially in London now, it's so busy that these new build developments tend to be in the outer suburbs or outside of the M25, in the home counties. But not everybody wants to move out to those areas. So, Propertunity. What is Propertunity? Propertunity is effectively a private equity loan, which is not restricted to new build properties. So you can approach Propertunity, and there are a few others out there who have very similar propositions, but Propertunity are kind of the market leaders on this at the moment. They've been around for about 3 or 4 years. You can approach them and say, I'd like to buy this non-new build 2-bed terrace home. They're going to give you between 10 and 25% of the property value by way of equity loan. Again, you only need to put in a 5% cash deposit, and then you take a mortgage for the rest. Now, they are a private lender, so unlike the government, they are going to charge you interest from day one because they want to make a profit. On top of the interest that they're going to charge you, they also have the equity stake in your home. So when you come to sell the property or remortgage or pay the loan back, they are also going to take their share of the capital increase or decrease. So if the property goes up by £50,000, you borrowed 20% from them, they're going to take £10,000 and you get to retain the £40,000.
So what do I mean by compromising? One of the biggest compromises that most first-time buyers make is the area that they're going to live in. Naturally, the further you go away from London, the more expensive it gets effectively. It's a tricky one for people that live in the southwest, the west, and the northwest. The reason why I say that is that your home counties are Surrey, expensive, Slough, Watford, expensive. However, when you come to east and southeast, where we're based, you've got Essex and Kent, which are a lot more reasonably priced. I'd say it's worth looking into those, see if the commute works. Sometimes you may pay a little bit more on the commute, but you'll get really, really good value for money. Compromising may look in the light of you may be compromising on getting a 2-bedroom rather than a 3-bedroom, or you really wanted a driveway, but for your first property, you're okay to do without a driveway. There's off-road parking. Then your next property, you'll get a driveway. Quite a lot of first-time buyers looking for semi-detached properties only. You may compromise for your first property and get a terrace property. The reason why I say compromising is good is that there's a reason that they call it a property ladder, right? You've got a first-time buyer on one hand who is paying rent, right? Huge expense. Living costs is probably the biggest monthly bill. And they're using their salary to pay rent, but they're also saving for a deposit. So their rent might be taking up 40% of their income, and they're saving 20% of their income, and they've got 40% for everything else effectively. And they have to compete with home movers. Now, a home mover is already on a property ladder. Now, home movers, a renter's living cost is their rent. A home mover's living cost is their mortgage. And even though they're paying an element to interest, which they've mentioned, every single month they're eating away at that capital. And it goes back to what I mentioned earlier, which is that you are accidentally investing in some cases if you're not fully aware of it. And what that means is that first-time buyers are paying rent for 5 years, 6 years, and saving. Whereas in a lot of cases, a lot of home movers don't actually save for their next deposit. They just pay off their mortgage, build enough equity by paying their mortgage down, and if house prices go up at the same time, they can pay their mortgage for, especially in this area, you can end up paying your mortgage for 5, 6 years, and then somehow you've cooked up a 60, 70K deposit. I always say buy for the next buyer. What I mean by that is that your property has to appeal to the majority of the market for it to maintain its value. What I mean by that is that you may drive, so you're thinking, I don't care where the bus stop is, I don't care where the train station is. However, we know that a lot of people commute into work using public transport. So think of the next buyer as well, not just yourself. This comes in a lot of elements as well. So if you're buying and there's, I'm going to go to something a bit later, I'll touch on something like schools. Schools are really, really good. Some of you are parents in here, and you know that people literally move home to get into the catchment area of the school, right? And they'll pay more money for that property. So things that may not be relative to you are really, really important that can help maintain the value in your home. So fundamentals of a good purchase. What drums up demand? I've touched on it already. Transport links, train stations. When I bought my first property, I thought bus stop meant nothing, right? Luckily, I bought near a bus stop, and you find that so many people use the bus to get to the train station. But also transport links include motorways as well. So any good road links, any road links that don't have loads of traffic, or any road links that people regularly use to get into the city. So I mentioned that Dave and I both live in the southeast. There's a road called the A2 that nearly everybody takes into London. Having good access to the A2 can massively help the value of your property. Schools and colleges, I've touched on that. Hospitals, right? We know why that's in capitals. If you live near a hospital, NHS is one of the biggest employers, so you just know that a lot of people, there's going to be a demand to live near the hospital. And it's not only for employees, it's for people that need to be going to the hospital regularly. Quite often these people are older. A lot of these people that are older, they have the means to choose to pay a premium to live near a hospital as well. Supermarkets, right? We'll touch on supermarkets and high streets. So a lot of people don't realise that a new Tesco superstore can actually boost the value in the property, because that's where people are choosing to shop at effectively. Big superstores, Asda's, Tesco's, and Morrison's can actually boost the value of your property as well. Regeneration of high streets as well. So sometimes rundown high street can actually deter buyers. Now, this is where you can win a little bit. I'm going to go down to the bottom right. If you can research in a certain area that you are interested in, and they've got like a rundown high street, you can actually look on the council website, and the council will give you information on any planned development. And planned development is a really, really good way to boost the value of your property. The reason is because not a lot of people may not know that high street is about to get regenerated, or they're about to build a bridge or a tunnel. Stuff like that, any infrastructure, any public spending to an area that you know about, that not everybody may know about, can hugely boost the value of a property. We can see that in places like any property that's on the new Elizabeth line, right? We've seen that there's been an uplift. When it was first announced and all the way till today, there's still going to be paying a premium for living near the Elizabeth line. We saw that with HS1, that's happened already, and we saw it with HS2, and we're still seeing it with HS2 as well. Huge employers, factories, warehouses. There's certain areas up north that have got an Amazon warehouse, and it completely changed the wealth of the area. And it just means that people are able to afford better properties, and it increases the value of the properties in the area as well. New major employers, right? It's quite difficult to know about new major employers, but sometimes you may have a competitive advantage. You may have a friend that knows that, for example, I worked in JP Morgan, and that's the example that I'm going to give. And there was a time that JP Morgan said that, Joe, we're going to open a new office in Bournemouth, and we're moving 40% of the staff to Bournemouth, right? And that is, a lot of people weary about that, they don't like being moved, but I see that as a competitive advantage. The reason why I see it as a competitive advantage is because I've got my property hat on, right? And I'm thinking that if they're going to move 40% of the staff to Bournemouth, right, that's a huge amount of wealth that's going to be going into Bournemouth, because these guys are still going to be earning JP Morgan salaries. JP Morgan is an American investment bank. I also found out that American Express is moving to Bournemouth as well. And if you look at the figures, when these two major employers actually moved to Bournemouth, you saw house prices creep up a lot faster than they were previously. So any kind of competitive advantage you can get. And I say competitive advantage, it's quite weird to find out how to get it, but sometimes you can get it by accident, right? You may have an area that you're not used to. You may have an auntie that they're putting letters through her door to remind her that, do you know what, we're building a train station just to let you know, there's going to be some digging, blah, blah, blah. And the thing about these letters, they have to consult the residents first, and the wider public may not know about it. This is a competitive advantage because you can look at where that train is stopping. Imagine knowing about the Elizabeth line before everyone else. It's a no-brainer, right? It's the capital appreciation, effectively. The infrastructure, train stations and bridges. And then with the Czech developments, I always mention that you want to keep an eye out on public spending and private spending. So public spending is your bridges, your tunnels, the train stations, the tube lines, anything where the government is spending money. But you also want to look at private spending as well. And what I mean by private spending is home builders. They've touched on home builders as well. So there's not that much new builds in London. But in the home counties, certain areas, you will find that they are propping up. Now, the way that you've got to think about it is, right, these home builders have resources, right? They may be worth 100 million, 200 million, 300 million, right? And their research department is going to be stacked, basically. And when you see them building a new development in a certain area, sometimes you've got to leverage their research. They would have looked at the fact that there's a growing demand in the area, there's sufficient transport links, and they're willing to hedge 80 million on a development in that area. So you can kind of leverage what they're doing and think that, do you know what, if they're building this area could be up and coming. So me too, I'm going to look at this area, do some research into what I can buy in this area as well. It's not on this slide, but I wanted to talk about what to look for when you're viewing a property as well, because this is a really important one. And what to be scared of, what to watch out for. So when you are inside the property, there's a few things that you really want to be really, really wary of. So the first thing is the roof. Now, again, competitive advantage. You may have a cousin that's a roofer, and that could be a good thing, because while the damaged roof will scare off a lot of the other buyers and reduce the competition, you may have a cousin that says that, you know what, no labour, I'll just charge you materials, and I can get that roof sorted. Another thing you want to look out for is cracks in the property. Now, if there's a crack in the wall, it may just be a crack in the plaster. One rule of thumb, right, is if you can fit a pound coin in the crack, it could be an indication of subsidence, which is movement underground that is affecting the structure of the property. So at that point, you probably want to get an enhanced survey, like a home buyer survey or something like that. Another thing you want to look out for is damp as well. House is spot damp. Some vendors who are selling their house, they may mask the whole property with like a fragrance so you can't smell the damp. But if you can smell it, damp has got like a musky smell. And then there may be like some black marks near the skirting board or in the corner near the ceilings. Kind of look out for it near like bathrooms and things like that, as damp can really, really affect the value of the property as well. Other things that I've mentioned as well, the area of the property as well. I always say that when you go on a viewing, you want to go at night and in the day. If you've got the time, go on the weekend and the weekday as well, because properties can look very, very different depending on the day that you go to view the property as well. And then finally, the other thing that I'll say outside the house as well is keep an eye on parking first of all, because sometimes the lack of parking can reduce the value of a property, and what the local residents are like as well. You want to make sure that you're comfortable in the property, but also the next buyers as well, they're going to be paying attention to the kind of residents that live in the area as well.
Kind of wrapping it up before we get into questions. Decision in principle. So if any of you are at a position where you're looking to get started on the property journey, first step you want to do is speak to a broker, have a conversation with a broker. What they're going to do is look to get you a decision in principle. Now, it's also referred to as an agreement in principle or a mortgage in principle. So effectively what this is a pre-approval from a lender. So what we do is we'd have a conversation, we would have a look at all the options for you. So if that's one of the schemes that you want to use that we've spoken about, or if you're happy just to proceed without a scheme, whenever it is, we'll figure out how much you can borrow and what's going to be the best way for you to proceed. We then put all that information in front of the lender. The lender's going to make an assessment. They're going to carry out a credit search. They're going to carry out their affordability checks. And then they're going to respond back, providing they're happy with a decision in principle. So it is merely a certificate that shows you've been approved by that specific lender, how much you've been approved for, and that all the checks are passed. So it gives you clarity on how much you can borrow. exactly what you might be looking at in terms of monthly payments, interest rates, those types of things. And it's also going to give you a head start for when you find the property that you want to buy. So once you have that decision principle in place, you can then go out viewing properties confidently, knowing this is in my budget, I can afford this, I've got it approved by the lender, I've got my certificate shown. So puts you in a good position to put an offer forward, because when you're speaking to estate agents and sellers, they're going to want to ensure that you've got the money to buy this. Have you got the deposit? Have you got the lending approved? So you can say, yes, I have. And I've put this down here. Sellers and agents will take you more seriously. I don't know if any of you have tried to book a viewing over the last couple of years, but we've got to a position now where the market is starting to slow a little bit, but it has been so busy during the pandemic that estate agents, the first question they're saying is, do you have a decision in principle? Have you got a mortgage pre-approval? And for most people, they say, well, no, I don't. And the agent will say, okay, come back when you do, and put the phone down. So it's so competitive out there, and it's so busy. To get one step ahead, get your decision in principle in place. Now, generally, it doesn't cost anything. So most mortgage brokers, me included, will not charge for a consultation. So have a conversation, iron out the kinks, answer any questions on a one-to-one basis, and then get a pre-approval in place for you without any cost to you. So you know that you can definitely go ahead and buy your home. So that's kind of step number one to getting going.